Hello, everyone. Very good evening to all our viewers, and welcome to yet another Power Pack session on Master Speak. Last week, we had the privilege of listening to Rita McGrath, author and strategy guru, on how to see around the corners and spot inflection points in business before they happen. If you missed the session, you can find the recordings of the session and others that we have done in the past on our website or LinkedIn or Facebook pages. And for all upcoming sessions, do follow us and get notified about these sessions well in time. Now, today we are going to talk about power of storytelling in driving corporate value and adding substance to numbers. Sounds exotic? Yes, you wouldn't expect any less from a session with Professor Aswath Damodaran. He's a professor of finance at New York University's Stern School of Business. He has been voted Professor of the Year by the graduating MBA class 5 times during his career at NYU and was profiled in Business Week as one of the top 12 US business school professors. Before coming to Stern, he also lectured in finance at University of California, Berkeley. He has written 5 books on valuation, 3 of them on corporate finance and on portfolio management, and his most recent book is Narrative and Numbers, published by Columbia University Press. His research interests include information, prices, real estate, and valuation. So if you're thinking as to how can a company that has never turned a profit have a multi-billion dollar valuation, or why do some startups attract large investments while others do not, you've got to stay with us for the next 1 hour and find out. But before we get there, I do hope all of you who are watching the show today are staying safe, are healthy, and all your loved ones are safe too. Let us know by clicking on the like button. Tell us which city or town you're watching us from, and don't forget to tag your friend, colleagues, or anybody you want to join this session with us today. Questions, which I'm sure a lot of you will have, and many of you will ask those questions. Make sure that you post your questions in the comment section. Keep them coming through the session. 2 lucky winners at the end of the show will get Amazon gift vouchers. So 2 lucky questions. You've got to stay till the end of the show and find out who the 2 lucky are. Of course, and keep asking those questions. Now, with that, join me in welcoming Professor Aswath Damodaran. Professor Damodaran, thank you so very much for being on the show today. I'm not
Thank
sure where you
you.
joined us from, California, New York, but we are all ears to listen to you.
Thank you. It's early in the morning for me, so I'm still waking up. I first want to make sure that that everybody's okay, but it's good to be here, and I will not give you any massive insights today. So if you're looking for deep thought and profound insights, you're looking in the wrong place because a crisis is a way of humbling you. It brings you back to earth, and there are 3 things that happen in every crisis, and this crisis is not unusual. The first is you lose perspective. You lose perspective about everything you know that is around you because you're focused on what's happening. The second is you lose faith. Faith in what? Faith in everything you thought you knew. Faith in what brought you to the table. And the third is you look outwards. You look for experts to tell you what to do. So, like you, I went through those 3 phases early in this crisis, and over the last 6 months, and it's amazing to believe it's been 6 months since the crisis started. I've been trying to negotiating a way of peace, and in fact, the word that I use here, serenity, is exactly the word that I'm looking for. A place from which I can look at what's happening and make my best judgments, even though I can be wrong. So what I thought I would do is take about 40 minutes, maybe 45 minutes, listing out the 5 big lessons that I've learned during the course of this crisis. None are profound, not all of them are new lessons, but they're lessons nevertheless that I think need to be re-emphasized. Here's the first one. During any crisis, especially when it's related to financial markets, markets would start to get volatile. And this market has been a volatile one, right? Especially as you think about the last 6 months, they go up, they go down. And the experts look at markets and markets have gone crazy. They're chaotic, and they do look chaotic. But before you pass judgment on markets, before you decide that they've gone crazy, think about it. Have you felt certain during these last 6 months? Do you feel secure? I look out of my window. I don't know whether I'll be back in a classroom this year, the next year, who knows when. I feel uncertain. You feel uncertain. We're all uncertain. Markets reflect that uncertainty. Here's one thing I've learned about markets. You can disagree with markets, but don't disrespect them. because markets always have their internal order. And this has been the most orderly crisis I've seen in my lifetime. Let me explain. When markets get into a crisis, they play what's called a pricing game. What's a pricing game? There are two words in investing and finance we use interchangeably that we should not. One is value, and we know what drives value. It's cash flows, growth, and risk. We've always known. Price is driven by demand and supply. It's driven by all of those fundamentals I listed, cash flows, growth, and risk, but it's also driven by mood and momentum. So when you think about those two words, we use them interchangeably, but they're driven by different forces and they can lead to different numbers. When you get into a crisis, markets become almost entirely a pricing game. What does that mean? Mood and momentum take over. In fact, I think one of the most frustrating and useless exercises you can go through is on a day-to-day basis trying to explain what markets do. So you watch CNBC, you watch Bloomberg, you watch any financial news channel. At the end of every market day, what do? The experts come on and they try to tell you what happened that day. What a waste of time. When you're playing the pricing game, what's driving the prices on a day-to-day basis is not some profound truth, some news. It's driven by mood and momentum. And because price and value are driven by different processes, they can diverge. And there are three areas where the two can diverge. Value has bounds, an upper bound and a lower bound. Let me explain. Earlier this year, I valued Tesla. If you're an optimist on Tesla, it's a company where everybody has a point of view. If you're optimistic about Tesla, you'll have much higher revenue growth, much higher margins, and a much higher value for Tesla. But there's an upper bound beyond which even you cannot go. If I'm a pessimist on Tesla, I'll give them much lower growth, much lower margins, and come up with a lower value, but there's a lower bound. Value has an upper and a lower bound. As opposed to what? Price has no bounds. If you ask me what's the highest price Tesla can be, I have no idea. Demand and supply, mood and momentum can take it to whatever price you want to take it to. I used to think that price had a lower bound. You know what the lower bound is? The price I thought could not go lower than zero. In every crisis, you learn new things. And in this crisis, I learned that I was wrong on that lower bound, and I'll explain in a couple of minutes what I mean by that. Second, price is reactive. What does that mean? To trade, to play the pricing game, you got to gauge what other people think. Remember the old Keynesian view of stock markets as being beauty contests, where your job is to not judge who the best looking person on the stage is, but to make a judgment on who the rest of the judges think is the best looking person on the stage. That's what pricing is. It's a game where you're trying to gauge what other people think, what other traders are going to do. Value is proactive. To value a company, you've always got to look forward. You got to forecast the future, even though you might be terrified of doing so. And third, there is this point of view that if price and value are different, price has to converge on value. At the risk of being sacrilegious, I'm going to push back. Why? Why does price have to push back to value? There's nothing in this process that requires convergence. And that can be frustrating. What does it mean? You can be right about value and go bankrupt. You can be wrong about value and make millions of dollars. There's no justice in this world. So with that setup, let me talk a little bit about what I've seen during this crisis. I started the crisis clock on February 14th of 2020. That's when the crisis hit the US, Europe, most of the markets outside China. Prior to February 14th, the Chinese markets had been showing the reaction to the crisis, but for some reason, the rest of us thought it would never get here. February 14th, we woke up to a crisis. And to put it in perspective, on February 14th, US equities and European equities were approaching all-time highs. So February 14th, the crisis starts. And for the next 5 weeks, we have a meltdown. Meltdown in what sense? Equities drop across the world. I focused here on 2 US indices, but I'll broaden it to the rest of the world in a few minutes. But you can see between February 14th and March 20th, equities drop. And in this case, the S&P 500 and the NASDAQ both drop by 30%. March 20th, something magical seems to happen. The mood was awful. If you'd been watching CNBC or Bloomberg on March 20th, you were convinced the world was ending. Something seemed to happen. The mood seemed to shift. And the same equities that had collapsed over the last 5 weeks started to turn around. And over the next 8 or 9 or 10 weeks, Now, if you look at what's happening, they've recouped almost all of the loss in the first 5 weeks. This has been a crisis that has played out in three acts. The first act was depressing. Markets were collapsing. The second act, markets soared. And the third act, they've consolidated and continued to go up. We'll talk about what happened around March 20th. But let's take a look at how, as stocks changed, the rest of the markets moved. Now, initially in the first 5 weeks, as stocks collapsed, you had what you see in almost every crisis. You had a flight to safety. What does that mean? People sell risky assets and try to hold on to something safe. For the last few decades, that something safe has been US Treasuries. And as people piled into US Treasuries, they pushed up the prices of US Treasuries and pushed down the yields. Across the board, the yields on US Treasuries dropped in the first 5 weeks. You saw the short-term yields, the 3-month yields dropped close to zero. The 10-year yields dropped from 1.6% down to about 0.7%. The 30-year yields went from about 2% down to 1.25%. All of this happened in the first 5 weeks. And then the US Treasuries seemed to go into a coma. Look at what's happened since. They've pretty much settled where they were on March 20th. Now notice I have two lines drawn in this graph. On March 15th of 2020, the Federal Reserve announced its first big announcement. It said it was going to continue what it started after the 2008 crisis, what was called quantitative easing. But the Fed would come in and buy US Treasury bonds. They announced about a $700 billion quantitative easing. 8 days later, realizing that the first announcement hadn't done much to calm markets, the Fed came back. They said that they were going to continue quantitative easing without an upper bound. They would go trillions if need be. But they added something that they did not do in 2008. They announced that there were going to be a backstop in the private lending markets. Doing what? They said they'd buy corporate bonds, that they would go in and lend money to companies that needed the cash. That was March 23rd. Hold on to that date, because that was the date when markets seemed to turn. Because when they announced it, you saw it play out in other markets. For instance, if you look at the corporate bond market, in the first 5 weeks, you saw what you have in every crisis. When people are afraid, they push up the price of risk. They demand a higher return for taking risk. It showed up as higher yields on corporate bonds. Here I've tracked 6 different classes of corporate bonds based on rating from AAA down to single B. And I've looked at high yield bonds as well. Look at what happened between February 14th and March 20th in every ratings class. Focus on the triple B bonds, for instance. If you look at the yield on a triple B bond, it was 1.33% on February 14th of 2020, start of the crisis. By the end of March, that yield had almost tripled in the bond market. People were terrified. They were demanding higher spreads. And then, as with equities, things seemed to turn around. The spread started to drop back down. They're now back down, perhaps not to where they were before the crisis, but they're well towards that level. Again, in the corporate bond market, you see the market play out in 3 phases. Now, along the way, I kept track of 2 commodities, oil and copper. Why these two? These are both economically sensitive commodities. If global economic growth is strong, these commodity prices tend to go up. If global economic growth is weak, they tend to go down. And again, you see it play out in 3 acts. In the first 5 weeks, both oil and copper drop in price. Copper dropped about 15%, reflecting the expectation that the global economy would slow down. But take a look at oil. It was down more than 50%. Clearly, there's something else going on in the oil market that had nothing to do with global economic slowdown. What was it? Well, initially, I thought it was the fight between Saudi Arabia and Russia, but clearly, there's other stuff going on here pushing down both commodity prices. That's through March 20th. And then things start to turn around. If you look at both commodities, they've come back. Copper has come back completely. It's now higher than it was on February 14th. Strange if you think about the fact that we're in an economic shutdown. But at least the copper market seems to be signaling that they think that this too shall pass. Oil is still down by about 20%, but that's well below, that drop is well below what it was on March 20th. So oil and copper. Finally, I looked at 2 other items, gold and Bitcoin. Why gold? Well, gold historically has been what people go to when they get scared, right? It's a crisis asset. And has it played its role? Yes, it has, to an extent. If you look at gold prices, they're up about 14% during this crisis, and they've held their value through much of the crisis. Bitcoin, on the other hand, I put in here because there are people who've argued that Bitcoin is millennial gold. What does that mean? If you're 35 years old and you panic, the argument went that instead of holding gold, you'd hold Bitcoin. Well, if that's the reason you're holding Bitcoin, it's not played its role. In fact, Bitcoin in the first 5 weeks was down more than 50%. And in the week since, it's up more than 70%. Bitcoin has behaved more like very risky stocks than like a crisis asset. I'm not beating up on Bitcoin. I'm just saying Bitcoin, if it has to have a role, it's not as a crisis asset, it's as a risky asset. So that's basically what happened across markets. Now, let me take a deeper dive into how stocks have behaved during this crisis. Every week during this crisis, what I've done is I've gone in and downloaded the data on every individual company that's publicly traded across the world. Sounds like a lot of work, but in today's day and age, this is not that difficult to do. Then I slice and dice the data to see if there's a message in the data. So here's the first thing I did. I took stocks and I broke them down by region. So I'd like you to take a look at the very last column on this page. What you would see is the damage across the entire 5.5 months. This is through July 17th, by region. Let me list out the 3 worst performing regions of the world. They're Latin America, they're Africa, and Eastern Europe and Russia. India's up there. But basically, emerging markets have been more affected by this crisis collectively than developed markets. If you look at the breakdown by period, though, take a look at global stocks. Global stocks were down about 30% in the first 5 weeks. If that doesn't strike you as a lot, here's what happened in the first 5 weeks of this crisis. Equities globally lost $26 trillion in market cap in 5 weeks. 26 trillion got wiped out. They're now down only about 4 trillion. That's a big comeback, but they're still down 4 trillion. But if you look at your global and US equities, they're down about 4%. Emerging market equities are down a lot more. Now we'll come back and look at what it is that might explain why emerging market equities are down more, but you see the breakdown by region. In fact, the worst hit developed market is the UK. And you can see one reason for that might be the Brexit factor on top of everything else that's going on. That's by region. If you break down global equities by sector, here's what you see. I'll list out the worst performing sectors, and you tell me whether you see something in common. There's energy, there's real estate, there's utilities. Notice what they have in common. Big infrastructure companies that tend to borrow a lot of money to fund their assets. You're saying, why are financials up there? Well, who's lending them the money for the most part? It's banks. Banks live in what I call reflected glory and reflected pain. In this case, banks have lent to energy companies, to real estate companies, and they're going to face some of the brunt of the defaults that are coming. If you look at the best performing sector, no surprise, healthcare. If you have a crisis created by a virus, not surprisingly, healthcare is going to benefit from the comeback. Technology has done pretty well. In fact, if you look at what the sectors that have done well share in common, they tend to be capital light businesses. In fact, let me reinforce this by breaking down winners and losers by industry. You have the 10 worst performing and the 10 best performing industries. Take a look at the 10 worst performing industries. A lot of infrastructure businesses, a few mining, natural resource businesses, and the best performing, you have a lot of capital light and healthcare businesses. Essentially, you see that this has been a market that's been discriminating in how it dishes out pain and how much it rewards winners. It's not a market that's going around punishing everybody. It's clearly reallocating wealth. If I were to sum up in markets, if you see the markets being volatile, it just reflects what we all feel. We're all uncertain. It's just reflecting that uncertainty. But it's been a market that's been very orderly in the way it's behaved in terms of stocks that have gone down and gone up. And early in this crisis, there was talk about shutting down financial markets. Thank God that didn't happen. When you're in a crisis, the best thing you can do is to leave markets open because liquidity is a salve, not something that exacerbates pain. Let people trade out their uncertainty. That's the best way to deal with uncertainty. So that's the first lesson. Don't be so quick to dismiss markets. Here's the second one. During any crisis, you get the experts come out, the gurus. And let's face it, most of these people have agendas. If you think that they're objective, let loose that notion. They have agendas, and what do? They use a crisis to advance their agendas. And I'll be quite honest. They advance their agendas and they just make up stuff. I was shocked as I listened to experts claim early on what was causing this crisis, what they were saying, because there was nothing backing it up. And what I've learned is when I hear people spout out about market something, the best way to do it is go check it with the data. So I'll tell you two stories I heard early in this crisis and how I checked them out. One was from old-time value investors. You know who I'm talking about? These are the people who read Warren Buffett, who believe that the best way to invest is to invest in old-time value stocks, mature companies with low PE ratios and high dividend yields. And let's face it, they've had a very tough decade. And I'll explain in a minute what I mean by that. And now they wag their fingers at the start of this crisis. I told you so. You shouldn't be buying these tech companies and young growth companies. You should be buying stocks which have low PE ratios and high dividends. Let's see if that's true. The second group that was using the crisis to advance their agenda was a group that over the last few years has become very upset that US companies in particular have shifted to using stock buybacks as their way of returning cash rather than paying dividends. They're convinced that this is an awful thing. And when this crisis started, they pointed to the airlines and Boeing saying, look, we told you so. Buybacks are what's getting companies into trouble. Let's see if that's true. So let's start with the value versus growth phenomenon. I told you that many old-time value investors have had a tough decade. Let me explain. For much of the 20th century, value beat growth. What does that mean? Low PE stocks did much better than high PE stocks in terms of returns. Low price to book stocks beat out high price to book stocks. That was through the entire 20th century. And value investors thought that they'd won this battle. And then you get to the last decade and things got upended. Growth stocks outperformed value stocks. High PE stocks did better than low PE stocks. High price to book stocks beat low price to book stocks. And value investors were convinced it was a passing phase. They said, just wait. Wait for a crisis and you're going to see why value investing is better for you. Well, they had their chance. And when this crisis happened, I decided to take a look at whether low PE and high dividend yield stocks were going to give you the protection that value investors said they would. So what you see on this page are two tables. The first, I've taken publicly traded stocks around the world and broken them down by PE ratio as of February 14, from lowest PE stocks to highest PE stocks. So the bottom decile are the lowest PE stocks. These are the stocks that value investors told me that I should be buying. Take a look at the lowest PE versus the highest PE stocks in the last column, and you will see that the lowest PE stocks have done a lot. In fact, the highest PE stocks are up. The lowest PE stocks are down. What about dividends? The stocks that pay the highest dividends have done a lot worse than stocks that pay no dividends. First, if I'd followed value investing advice and bought low PE stocks with high dividends, I'd have been hurt more than somebody who bought high PE stocks. To add on to this, let's look at momentum. Momentum is when you buy stocks based on what they've done recently. You buy stocks that have gone up, you sell stocks that have gone down. Something value investors would never do. During this crisis, though, it would have paid off for you. The highest momentum stocks have done much better than the lowest momentum stocks. So if this crisis was supposed to show us that value investing is going to work, it hasn't. It's actually reinforced the view that something is wrong with value investing. In fact, the one variable that seems to explain, or best explain, differences across companies in this crisis is debt. Companies with a lot of debt have done a lot worse than companies with very little debt. We'll come back and talk about how that plays out in this market, but that seems to be the real culprit explaining differences in returns across companies. So let's sum up. Value has clearly failed this crisis test. So if you were holding on to value stocks expecting this crisis to vindicate you, let go. But in my view, there's a reason why value investing is failing. Value investing, as we know it, has become lazy. In fact, there are 3 R words that I use for value investing, and none are complementary. It's become rigid. It's got rules. I have no idea where these rules come from. It's ritualistic. There are certain things you're supposed to do as a value investor. Certain gods you're supposed to pray to, one of whom is Warren Buffett. Everything he says is viewed as holy. You can't break it. And it's become righteous. Basically, value investors have become finger waggers. They're going to say, oh, you terrible shallow investors. They talk about bubbles. And if you don't bring something to the table, you're going to have nothing to take away. I call myself a value investor, but I think value has to be a much more dynamic concept. In my concept of value investing, there's nothing that stops me from buying a young growth company if the price is less than value. So I think we need to rethink what value investing means. One thing that I think has helped me during this crisis is a concept that I've used in my classes of a corporate life cycle. In a corporate life cycle, you have startups that become young growth companies, that become mature companies, going to decline and then into distress. Like human beings, companies go through a life cycle from young to old. So one of the things I decided to look at during this crisis was how the crisis was affecting companies at different stages in the life cycle. Remember, in most crises, you know who gets hurt more? Younger companies get hurt more, older companies get hurt less in most crises. In this crisis, that's not been the case. The youngest companies in this market, young in terms of corporate age, have done much better than the oldest companies. Take a look at this table. Take a look at the last column, youngest to oldest. The youngest companies have done much better than the oldest companies. High growth companies, which tend to be young companies, have done better than low growth companies. This crisis, in a sense, mirrors the virus. It's been much tougher on older companies than younger companies. And I think that there are reasons for it. One is, I think this crisis is fairly unique. In most crises, markets tend to melt down first. The economy tends to reflect it later. Remember 2008, markets melted down, economy slowed down. 2001, markets melted down, economy slowed down. Great Depression, markets melted down, economy slowed down. This crisis, markets were doing well, then the economy got shut down first. Maybe there's something in that sequencing that matters. Second, when the economy shut down, we were told that we'd open up on a specific date. They were lying, we didn't know it then. And thirdly, in most crises, private risk capital leaves the game. You know what I mean by private risk capital, venture capital, investing in young companies, IPOs, all cease to happen. That's not been true in this crisis. If you look at this crisis, risk capital has stayed resilient. It stayed in the game, even in the worst days of this crisis. Let me back that up. If you look at venture capital, for instance, venture capital in a typical crisis, go back and look at 2008, the last quarter dried up completely. In this crisis, there was a little drop off in the first quarter, but it's back. Maybe there's less venture capital going into the youngest companies, but it's still there. That's different. If you look at IPOs in most crises completely stopped. There was only one IPO, in the last quarter of 2008. IPOs have stayed in the game in this crisis. And finally, if you look at the price of risk in the equity market, I captured with what I call an equity risk premium. I've been computing what the equity risk premium has been by day during this crisis. Early in the crisis, you saw what happens in every crisis. The equity risk premium, if you look at the power portion of the graph, the first portion of the graph rose from 4.8% to about 7.8%. So it looked like a typical crisis. But take a look at what's happened since. The price of risk in the equity market is now back down almost to where it was before the crisis. Equity markets are seeing the risk play out. And for whatever reason, equity markets seem to be saying, hey, it's okay. Now, if you look at how this has played out in equity risk premiums around the world, one of the things some of you might be aware of is I compute an equity risk premium by country. Usually I do it twice every year, at the start of the year and the middle of the year. So January 1st and June. This year, I actually did an April 1st update because I was worried about how much premiums have gone up. I've tried to capture all three risk premiums on this graph. So take a look at Asia. I'm going to focus on India because a big chunk of this audience is Indian. At the start of this year, I estimated the equity risk premium for India to be just over 7%. Why was it so low? Because the equity risk premium in the US was 5.2%. Default spreads on sovereign bonds had dropped. Across the board, people were feeling pretty sanguine about risk. So that's the green number is the January 1st number. Take a look at the second number, around about 9.5%. That's a 2.5% jump in 3 months. What happened? Well, the crisis happened. Equity risk premiums rose in the US, default spreads rose around the globe. Equity risk premium in India had gone up to 9.5% by April 1st. Take a look at July 1st. It's back down, maybe not to where it was before the crisis, but to 8.5%. It reflects again the fact that people have stepped back from the brink, at least in terms of the price of risk. You see this play out. What does this all mean? You could have valued the same company on January 1st, April 1st, and July 1st of this year. Cash flows are exactly the same. You could have got three very different values for the same company because the price of risk has been shifting in markets. So that's a second lesson. If don't be, it's whenever somebody tells you something about the market, listen, but check for yourself. The data is out there. We focus in on my third lesson. I've been told for as long as I've been in investing that there's smart money and stupid money. You heard the legend, right? Who's the smart money? They're the hedge funds, the professional money managers, the market gurus. So the stupid money, it's retail investors. They're uninformed. They tend to act on emotion. Smart money is supposed to get into markets ahead of everybody else and out of markets ahead of everybody else. It's supposed to pick the right stocks. Stupid money just leaves money on the table. So that's the legend of smart and stupid money. And I'll make a confession. For 40 years, I've been looking for smart money and I haven't found it. I'm convinced that there's no such thing. Let me back it up. Over the last decade, you've seen a game being played out between smart money and stupid money. Remember, smart money, I said, is professional money managers. They run hedge funds, they run mutual funds. Stupid money is retail investors. For the last decade, there's been a contest between smart and stupid money played out between active and passive investing. Let me explain. Active investing is when you invest in professional money managers, mutual funds, hedge funds. Passive investing is when you put your money in index funds and ETFs. And for the last decade, hedge funds and professional money managers have been losing out tremendous amounts to index funds and ETFs. What you see in the green column here is the money flowing into index funds and ETFs, and the red is the money flowing out of professional money managers. It's been happening for a decade. And for the last decade, whenever I've talked to hedge fund managers or professional money managers, they said, well, you're right. There's a trend, but wait for a crisis. During a crisis, you'll see how much you need us. I said, okay, now you have your chance. Let's take a look at how the smart money has performed during this crisis. First, let's look at mutual funds. You see the blue line there? That's the S&P 500. You could have, as an individual investor, if you bought the Vanguard 500 index fund and any S&P 500 index fund, you could have delivered that return with no transactions costs. See the yellow line? That's what professional fund managers have delivered as returns. That is during this crisis. Doesn't look like professional money managers have done much for you in the crisis. In fact, 74% of active funds have underperformed the index during this crisis. So active mutual funds have underperformed. You're saying, what about hedge funds? They must be smarter, right? Not really. If you look at the period during this crisis, again, indices have outperformed hedge funds during this crisis. Both mutual funds and hedge funds have been put to the test, and at least during this crisis, they failed. In fact, for the last 6 months, and one of the most embarrassing phenomena ever, there's this phenomenon called the Robinhood app phenomenon. Robinhood app is an app for people to do day trading. And the people who are most on the Robinhood app are not professional investors. They're actually gamblers. The reason I say the word gamblers is these are people who usually make their money betting on sports, but because sports have shut down, they're on the Robinhood app investing in stocks. Trading on stocks, investing is a strong word. And they're open about the fact that they know nothing about stocks. They boast about it. They say, I know nothing. I've never looked at a financial statement. I'm just going to buy and sell based on momentum. You know what this graph shows you? It shows you the returns that those investors have made versus the returns you'd have made investing in stocks held by hedge funds. And over the last 6 months, the Robinhood app investors, the completely dumb money, this is dumb at a new level, has beaten out hedge fund stock picks by almost 16%. Think about it. People who know nothing about, I'm not saying you should just trade like the Robinhood app traders. They're like gamblers. You know, sooner or later, they're going to lose it all. But my point is it's revealed the emptiness of so much of professional money management. So here's the bottom line. If you're looking to somebody to manage your money, don't look for smart money. There's no such thing. In fact, I've suggested a different line between in money that I would look at if I thought about somebody to manage my money. I want my money to be managed by somebody who's humble. You know what humble money does? When it succeeds, it knows that much of that success is a function of luck. That luck is the biggest variable that drives whether you succeed or fail. And when you fail, humble investors look inwards. They say, what did I do wrong? So when they're successful, they know a big chunk of success. They don't claim it for themselves. When they fail, they look for things to do better. You know what arrogant investors do? When they fail, it's always somebody else's fault. It's a Fed's fault. It's a government's fault. It's stupid money's fault. It's a market's fault. And when they win, it's a sign of their brilliance. So much of professional money management is arrogant money. I would not trust Masa Son to manage my money. He's a brilliant man, but he's an arrogant man. When WeWork and SoftBank came together, that was a marriage of arrogance made in heaven. And that bring down that you saw in the last year in WeWork and SoftBank was a reflection of how markets treat arrogance. So rather than look for smart money, look for humble money. And you know what? Humble money will never charge you 2 and 20 like hedge funds do. That's a sign of arrogance. When you charge me 2 and 20, you're saying you can beat the market and beat the market by enough to cover in 2 and 20. I don't want to have any part of what you're doing. Which brings me to my fourth lesson. In every crisis, you're told that the fundamentals don't matter. Why? Because you're in a crisis. And I'll tell you something. In every crisis, I've discovered fundamentals matter more than ever before. Let me back that up. I mean, every year for the last 30, 35 years, I valued the entire S&P 500. In fact, I use this approach to value any market. And how do you value an index? You value it like we value any company. Project out the expected cash flows in the index, which if you're investing in the entire index takes the form of both dividends and stock buybacks. You project out the growth in those cash flows, and then you discount those cash flows back at a discount rate that reflects a risk-free rate, what you can make without making any risk, plus an equity risk premium, price of risk in the equity market. That's how I've always valued the index. Now, when the crisis is hit, I was told that this wouldn't work. In fact, you probably heard the story about how markets have gone crazy. Why have they gone crazy? If you look at what's happening in the economy around the world, the US economy, the Indian economy, the global economy, the economy is in trouble, right? There's no doubt about it. Unemployment has soared, production has dropped, consumer confidence is low. How can it not be? In fact, when people say, well, how do you explain the economy doing badly? I say that's like parking your car in the driveway and then checking the speedometer and saying, it doesn't seem to be going above zero. It's parked. We're in a shutdown. Of course, the economic news is bad. But then people say, well, how do you explain markets? Well, in a minute, I'm going to, but remember, markets are not supposed to explain what's happening right now. They're supposed to reflect what will happen in the future. They're forecasting mechanisms. But I've been told that they're forecasting something that's not going to happen. In fact, I've been told that markets are in denial about how terrible things are. Well, let's see if that is true. This graph looks like it's complete chaos, but here's what I've done. I've graphed out two series. The green line is real GDP growth in the US going back to 1960 by quarter. That's real GDP growth. That's how well the economy is doing. So when that number is positive, the economy is doing well. When that number is zero or negative, the economy is doing badly. The red line is what stocks have done in the same quarter. Take a look at the table at the bottom. The correlation is what is a measure of how stocks and the economy have done in that quarter. If you look at the correlation between stock returns and real GDP growth in the same quarter, the correlation is close to zero. There is almost no relationship between what happens to stocks and what happens to the economy on a quarter-to-quarter basis. You see, this is terrible. Are markets completely chaotic? Not necessarily. As you go forward, you find that the correlation increases. What does that mean? Well, if you look at 3 or 4 quarters ahead, the market and real economic growth 4 quarters ahead, the correlation is 0.28. Two things to notice. One is markets are forecasting what the economic growth will be in the future. And two, they're noisy forecasters. Markets are not perfect. They're trying their best to forecast the future. And if you try to explain what markets are doing right now, what they seem to be doing is that they seem to be looking past the virus saying, this too shall pass, economies will come back. Maybe they're wrong. So here's what I did on June 1st of 2020. I decided to value the S&P 500 because I heard people say people are crazy. The markets have gone crazy. This was when the S&P 500 had hit 3,030. It was almost back to where it was before the crisis. And people saying, how can this be? So here's what I did. I brought the crisis into my fundamentals. In what sense? Well, the fundamentals are going to wreak havoc on earnings in the near term. So I brought down earnings for 2020 and 2021 substantially. They're also going to lead to a pullback in cash flows. Buybacks and dividends are going to drop. Dividends are going to drop by about 20% in my estimate this year. Buybacks are going to be down 50%. Risk premiums are going to go up. Why? Because you're in a crisis. And the risk-free rate has dropped. This is one of the few positive things that will happen in this valuation. I valued the market with those changes put in. Much lower earnings and cash flows. You look at the table in the top, you'll see how much I've brought down earnings next year. My expected earnings next year is 120 is going to be 120 as opposed to the 165 or 170 that people were forecasting before. I've brought down next year's earnings dramatically, and dividends and cash flows as well. And with that fairly sober view of the future, the value that I got for the index was 2,930. Now remember, stocks were trading at about 3,030. That was within 4% of my estimate. My bottom line was, don't be so quick to conclude markets have gone crazy. There's a plausible story you can tell that explains where markets are today. In fact, what I did was I brought out one of the tools in my tool chest. It's called a Monte Carlo simulation, where I took my big assumptions, each of which I could be wrong on, and estimated the value for the index under different combinations. I ran about 100,000 simulations, and here's what you get out of this. 50th percentile, you get about 2,930, pretty much what I got with my expected value. But remember the 3,030, that's about the 61st percentile. There's a 39% chance stocks are still undervalued. So don't be so quick to dismiss markets. The distribution is a pretty wide one. It forces, in fact, it's a lesson I draw on is don't be afraid of uncertainty, face up to it. Which brings me to my final lesson before I open up for questions. I've been long worried about a trend I've seen in valuation, where we've been increasingly dependent on Excel spreadsheets to value companies. In fact, we've turned over, valuation has become financial modeling. So about 4 years ago, I wrote one of the favorite books I had to, in terms of writing the book itself, called Narrative and Numbers, about connecting stories to numbers. Because I'm convinced that a good valuation is a bridge between stories and numbers. Let me explain. In a good valuation, you point to a number and ask you, why is your revenue that number? It should always be backed up with a story. Or when you tell me a story about a company, say, how does that story affect value? It should be always backed up with a number. A good valuation is a bridge between stories and numbers. That was 4 years ago. Okay? Now you're saying, wouldn't a crisis change that? More than ever, I think we need to go back to basics. In fact, in my book on stories and numbers, I went through a 5-step process to value a company. I said, start with a story for a company. I don't care what the company is, it always starts with a story. Then check and make sure the story you've told is not a fairy tale, that it's possible, plausible, and probable. 3 P words, but with each one I'm raising the ante. Step 3, take the story that you've checked and convert every part of the story to a number. I think of valuation as a series of levers. There's a growth lever, there's a profitability lever, there's a risk lever, and I use the story to work with those levers. Step 4, the numbers I've chosen play out as a value. So my stories become a value. And then there's a step 5, where you show your story to other people, and then you don't get defensive when they find things wrong with your story. Listen, I call this keeping the feedback loop open, where you make your story better. So I'll give you an example of how this played out. Early this year, I valued Tesla. Tesla is a company I valued almost every year, going back to 2013. It's a company that I'm fascinated with. It's the ultimate story stone. So in January 2020, when I valued Tesla, I valued it as a story company. To give you some background, I valued Tesla in June of 2019, and I bought Tesla at 180. I got incredibly lucky. As I said, often when you make money in stocks, it's because you were in the right place in the right time. I happened to be in the right place at the right time. I bought the stock at 180, and then it kept going up and up and up. A good problem to have when you own a stock. So this was in January 2020. The stock had hit about 580. I sat down to value the company, and I gave a pretty expensive story. The story I told for Tesla was that it was going to become one of the largest automobile companies in the world with revenues of about 130 billion. That would make them the fourth largest automobile company in the world. Just to give you some perspective, their revenues, when I value them, are about 30 billion. I'm giving them revenues of close to 130 billion. Their margins, I assumed, would converge on tech company margins, as opposed to what? As opposed to auto companies. So in my story, Tesla is going to become a large auto company in terms of revenues, but manages to keep its margins at close to tech company margins and reinvest more efficiently than a typical automobile company. So it's a pretty upbeat story. My upbeat story, the value that I got was $430. Remember, I told you I value the company because I owned the stock. The stock had actually hit 640 the day that I finished this valuation. I sold the stock. Now, for those of you who've tracked Tesla, you're saying, you dumb idiot. You're right. I've left a lot of money in the table, but I have to play the game I came to play. And at least based on my valuation, the stock looked overvalued. But my point is, in January 2020, I valued Tesla based on a story. Now, do you think because you're in a crisis, you let go of this? Not at all. In fact, more than ever before during this crisis, I've had to go back to storytelling. And here's why. If you focus on the damage created by this crisis on the company, it's going to be overwhelming, right? You're going to focus on what an airline or a steel company is going to do this year, next year. It's going to be abysmal. You got to look past the crisis. You got to tell a story about what you think this company will look like after the crisis. And I actually devised a spreadsheet to do just this. Nothing magical. I took my basic Excel spreadsheet that I used to value companies and added a COVID twist to it. In fact, there's a YouTube video you can find for using this spreadsheet to value any company. And basically, in the COVID twist, what I ask you to do is estimate the short-term effects of this crisis on earnings in 2020 and 2021. And then tell me what the company will look like after the crisis. Remember, I said you have to tell a post-crisis story. And I said, you could still value companies. And you're saying, right. I actually valued Tesla a few weeks ago. This is post-crisis. I think this crisis is actually going to help Tesla. You're saying, how can a crisis help companies? Crises live winners and losers. And this crisis is going to help Tesla because it's going to hurt its competition. Why? Its traditional competition is auto companies, which have big infrastructure investments and a lot of debt. If you remember what types of companies this crisis has hurt the most. Big infrastructure companies with a lot of debt. This company, I think, is going to make Tesla a stronger company. That's what I built into my story. My story is now more expansive. The easiest way to see it is if you look at my revenues in 10 years, remember the old valuation was 130 billion. Now I'm giving Tesla $200 billion in revenues in year 10. My story for Tesla is much more expansive because of the crisis, because I think the crisis is going to help Tesla. Now, notwithstanding the bigger story, the value that I get for Tesla is about $600 plus, well below the $1,400 it's trading at. But that doesn't take away from the fact that I'm still sticking with the storyline and valuing the company. In fact, to close for today, I'm going to do the same thing with two very divergent companies. One is Zoom, the company that has benefited immensely from this crisis. And this valuation I did in May of 2020. Zoom is already zooming in terms of its stock price. I valued the company with a much more expansive story than I'd have used just 4 months earlier. This crisis is going to expand Zoom's potential market. But notwithstanding it, with a bigger story, I'm still finding Zoom to be overvalued. So I said, look, you might like Zoom, its story might be bigger, it's going to be a more valuable company, but I can't justify the price. In contrast, I did value Boeing in March of 2020. And if you think about a company that is almost tailor-made to be hurt by this crisis, it's Boeing. Why? Because it makes aircraft. And people fly in airlines, and airlines are all shut down. So in March of 2020, I valued Boeing with a very depressing story, a story of them continuing to lose money with a 15% chance of failure, much more risk than a typical company. But I found a value of about 160. Stock was trading at 132. I own Boeing. I don't own Zoom. The point I'm trying to make is just because you're in a crisis doesn't mean you abandon fundamentals. You still tell stories. You still try to value companies. And if you do so, if you keep the faith, then you're going to find that a crisis is something you can get through. And the first rule when you're in a crisis, don't fight the uncertainty. Accept it, deal with it, be realistic about it. But then lift your eyes up. Don't get focused on what's happening right now. Think about the future, because investing is all about the future. So I'm going to close up for the moment and open up for any questions you might have. So thank you very much for listening, and I'm going to stop my sharing so that I'm on the screen. Okay.
Thank you very much, Professor Damodaran. How I wish this was a full day or a couple of days, or maybe a week session. Thank you very much for sharing
You're
such
welcome.
powerful insights with us. We got lots and lots of questions here, and I'm struggling given the fact that we have only 15 minutes with you. So I'm going to try and make it as quick as possible. Um, so first off, interestingly, Rita, in her last session last week, uh, you know, started from where you ended, which is develop a narrative for the business or future. One would have never imagined the power of storytelling to make or break $1 billion fortune. And coming from a valuation guru such as you, it sounds even more intriguing. So the first question, which is always my privilege, benefits of the job, Professor Damodaran, is very simple. Valuation to you, is it more of an art or science or neither?
It's a craft. I mean, basically, the reason I don't call it a science is in science, if you get the inputs right, you get the output right. Valuation, you have zero chance of that. You can get every single input right based on what you know and be horribly wrong. So it's not a science. It's not physics. It's not math. It's not an art either. Art is just a cop out, because when you say something is an art, you can say, I can do whatever I want as long as I do it creatively. It's a craft. You got to work within the confines of reality. In fact, when you talked about stories, you got to be very careful. In Silicon Valley now, you have storytelling classes you can take as a founder, because founders have discovered that they can tell really, really big stories and people fall for the story. With valuation, your story can't be a fairy tale. It's a story bounded by reality. And that's where you got to be careful. You can tell a story, but you got to be honest with yourself about whether that story actually can fly. A lot of stories cannot fly. I think they're problematic from that perspective. It's a craft, and the essence of a craft is the more you work at it, the better you will get at it.
Superb. So I'll dive into questions from audience, Professor Damodaran. So this one is from Madhu. Madhu wants to know, it appears from the session that access to global markets, asset-light business, tax arbitrage, technology-driven companies with access to tons of capital is equal to crazy valuations. But what about management prowess? So people, how much credence do you put on people while valuing companies?
First, when you use the word crazy, use the word bubble, use the word irrational, you're already setting yourself up, right? Because what does the word imply? There are other people have no idea what they're doing that you do. Stop playing that game. I mean, you're not the only sober person in a room full of drunk people. I think the notion, let go of so if you want to say valuations look high, I'll go along. They look optimistic, okay, but don't call them crazy. How much do people matter? They do. I mean, in a sense, when you talk about telling a story for a company, that story reflects the people running the company, right? What's Tesla's biggest strength? A guy called Elon Musk. He's a visionary. The guy has visions coming out of every orifice of his body. But you know what Tesla's biggest weakness is? A guy called Elon Musk. The guy is human. When you have a story built around people, remember, people get older, people are fallible, people die. One thing that always has terrified me about people who buy Berkshire Hathaway because of Warren Buffett is the fact that Warren Buffett is 91 years old. I mean, this might sound morbid, but this too shall pass. And then what do? I'm very, very careful about investing in companies where it's a personality that's driving the valuation. If it's a management team, I'm more confident. I'm even better off if there's a transition process where I see a process where the next phase of management is being trained. Those are the companies that build value for the long term. There's a reason Microsoft has made its way back to becoming one of the largest market cap companies in the world. It's because Bill Gates was willing to let go, right? Founders need to know when to leave. If they stay in the game too long, they can ruin what they built up so carefully. So build around people, but be careful if it's a particular person or a group of people, because then you're building on something that will pass.
Fair enough. The next question, Professor, is from Rajat Sridhar. And Rajat's question is, while equity markets have melted up and consolidated, other asset classes coming back to pre-COVID levels, as you've shown in your presentation, how do you explain the fact that consumer sentiments are so divergent from market sentiment? And do you see markets finally catching up and eventually catching up to consumer sentiments because economic activity is so low, or it's going to be the other way around?
Well, Rakesh, would you call yourself a consumer?
Yes,
Yeah.
I'm
What do you feel right now? I mean, you're probably stuck in your house. You're looking out of your window. You can't get in your car. You can't drive to a store. Do you feel in a good mood? I don't think so. Consumer sentiment reflects where we all are right now. How can consumers feel upbeat when you're stuck in a house? You don't know whether you'll have a job. Of course, consumer sentiment is in the toilet. In fact, I'm surprised it's not even more in the toilet. If I ask you, what will your sentiment look like a year from now? Your first response is, I have no idea. You know what? Markets don't have that luxury. They got to forecast out what your sentiment will look like a year from now. And I think that markets are being upbeat. Maybe you can disagree with that upbeat assessment, but don't look at sentiment today. That's not what markets are supposed to measure. They're forecasting machines. And you can disagree with that forecast, but their assessment is a year from now, consumers will be a lot more upbeat. They'll be returning to markets. Markets could be wrong, but that's the assessment that's being built into stock prices today.
Interesting. Thank you so much for that, Professor Damodaran. This next question is from our CEO and MD, Mr. Munish Shada, and I think it's from one of the slides that you presented where you mentioned about humble investor and arrogant investor, and that you would always go for the humble investor. So the question is very simple. How does one figure out the difference between humility and arrogance when choosing
Just
from
the first thing.
investors?
First, look at what they charge you. If it's 2 and 20, walk away from the table. 2 and 20 is a classic hedge fund thing, right? Now, first thing is when you charge me outlandish fees, what are you already telling me? You either believe you're so good that you can beat the market by enough to deliver those fees, or you don't believe it, in which case you're taking me for a ride. Either way, I don't want to have any part of you. Second, if you keep talking about your skills, where you went to school, in fact, I'm very, very wary of people who add on their qualifications to their name. I am so and so, CFA, PhD, etc., etc. How many more qualifications do you need to add? The less you talk about yourself, the more you talk about process. The less you talk about what you don't know, what you know, the more you talk about what you don't know, the more inclined I am to trust you. I'm always wary about people who talk in certitudes, who feel that they're right and the rest of the world is wrong. So it's common sense. Just some people, you know who the arrogant people are. You've known them since you were in high school, right? Those are the people you want to avoid in investing.
Fair enough. The next one is from Mohit, Professor Damodaran, and this one is uh, it's about time periods and price. So time period seems to sway people into believing that things which may or may not be true. So if you were to look at price movement in 1, 3, 6 months duration, like we just saw, you would say, geez, this is doomed. However, when you expand the time frame to 3, 4, 5 years, it just looks like maybe you missed a great opportunity. So how do you suggest retail investors look at investing because they may not have access to all the data analysis,
Come on, that's
so on
not
and so forth.
true. Don't use that excuse on me. What do you not have access to? What do you think professional money managers know? They know nothing. In fact, if you're operating under this delusion that professional money managers have a secret door that they open to information, they don't. So you're a retail investor. This is a much flatter world than used to exist 40 years ago. You have access to data that you only would have dreamed about accessing 40 years ago. Second, I think in hindsight, you can always look back and say, if I had invested at that point, stop looking backwards. Regret is the most dangerous emotion in investing because then you live the future based on what you've missed in the past. Look forward, find your niche as a retail investor, find what makes you work, what makes you comfortable. Find an investment philosophy, not a strategy, an investment philosophy that best fits you, and then stay true to it. Will it guarantee that you make money? No. This is too much of a game where luck drives everything. So be accepting that you can do everything right and have nothing to show for it. and you can be okay with it. If you're not okay with it, put your money in an index fund and go back to doing what you're doing with the rest of your life. But don't invest expecting to get rich. Investment is about building wealth. It's not about creating wealth. So if you get rich, that's great. It's like icing on the cake, but it shouldn't be the driver of how you invest.
Okay, the next one is what are your views on valuations in emerging markets, Professor Damodaran? There is a hypothesis about a likely sell down looking at the market cap to GDP ratio. So, do you subscribe to market cap to GDP theory?
It's a ridiculous ratio. I know Warren Buffett uses it, but lots of things that Warren Buffett. You know why it doesn't make sense in most emerging markets is most of the economy is not public in most emerging markets. It's private businesses. So here's a very simple scenario where market cap to GDP is going to rise over time. As more and more private businesses come off the sidelines and become public companies, the market cap to GDP will rise. So stop even using that ratio. I'm amazed that people even look at that ratio anymore. If you want to compare market cap to earnings, of course, companies are trading at much higher multiples of earnings. But guess what? If you look across emerging markets, and you look at the required return you demand for investing in companies, an Indian company, for instance, in rupee terms, the cost of equity 20 years ago was about 20% plus, 25% plus. Today, it's closer to 12 to 15%. Holding all else constant, that's going to bring up multiples. So when you're comparing multiples across time, factor in the lower rates of return that people are demanding for investing in these companies. And that explains, at least partially, why stocks are trading higher than they used to.
Great. Thank you, Professor Damodaran. We've got a couple of more minutes, so maybe two more questions
Sure.
with your permission. This one is from Rahul. You spoke of Bitcoin, and I think what we saw that Bitcoin behaves like any other high yield equity. So would you say that this is
it's a high yield equity without any of the good stuff that comes with equity, right? Because equity, you have cash flows, you have dividends. Bitcoin is a volatile currency.
right? So do you see the question therefore is that do you see more regulation to dampen the whole cryptocurrency economy, or this is something that is going to stay?
Economy. What is this crap about a cryptocurrency economy? You know, the sum total of all of the cryptocurrencies put together is in terms of pricing. If you add up, Ethereum, Bitcoin, collectively, the value of all cryptocurrencies put together is $200 billion on a good day. 200 billion. You know how much cash Apple, one company, has as a cash balance? 250 billion. You know what? More time has been wasted talking about cryptocurrencies in the last decade than any other item in finance. This is, in my view, if you look at the larger scheme of things, a very small piece of a very large puzzle. Do I think that there is room for a digital currency? Absolutely. But I don't think Bitcoin or Ethereum or any of the existing cryptos quite meet the constraints of a good currency. That's what makes me skeptical about Bitcoin. It's not because I don't think a digital currency doesn't work, but I don't think Bitcoin is designed to be a good currency.
That brings me to the last question. I realize, Professor, that you have another engagement to go to. So, any message that you would like to give to our audience who may be in early years of their career, and there are quite a few watching us today. So, in the context of changes this pandemic will drive, how might they be focusing on the skills that will help them thrive in future?
Yeah. I think the first thing to do is don't try to do too much too quickly. I mean, life is incremental. If you go out there and say, I want to be the greatest this, the greatest that, the highest paid this, I think you're going to overreach. Take it a day at a time, learn something new every day, and don't stop learning. I mean, this is a process that incrementally will build up. And if you work on that, the rest of it will take care of itself.
All right, with that, we come to an end of the show. Thank you so much, Professor Damodaran, for being with us, sharing such interesting perspective. It was an absolute pleasure listening to you, and I'm sure our audience enjoyed. There's lots and lots of questions. I must apologize to our audience. We only had time, 15 minutes available with us from Professor Damodaran, but we tried to do our best. But once again, thank you so much, Professor Damodaran, for being with us. It was a total pleasure to have you on the show.
Thank you. Appreciate it.
Okay, sad but true. That brings the curtain down on the show today. As much as we wanted to go on, Professor Damodaran had another engagement, and once again, apologies to all the audience whose questions we couldn't ask. A bunch of them which I see on my panel, but as all good things come to an end, we had a time to keep. So, thank you very much for watching us today, for being with us. Continue to stay with us. There are lots more exciting sessions coming through. We have some very powerful speakers coming up. Next week, we have another very powerful speaker. I'm going to talk about that in a bit. But I want to first pick up the two lucky questions for the day. The first one is from Madhu Sapra, and the question was around crazy valuations. Madhu, please let us know your email ID, and we'll be happy to uh, ship the voucher to you. We need to know your email ID for us to be able to do that. And the second question that I would like to pick today is okay, this is a tough one. So from Rajat, Rajat's question was around consumer sentiment and whether they will catch up to market or market will catch up to consumer sentiment. So congratulations, Rajat and Madhu. Send us your email IDs and we'll ship the voucher to you. A big thanks to our community support partner, Resultix, AdGully, Netcore, Paul Reiter, and Shulini University. Thank you for being with us. Thank you for endorsing our show and making sure that the message is spread across length and breadth of the country, and more people are benefiting from this. And a big thank you to our knowledge support partner, etbrandequity.com. Thank you very much, guys, for being with us. Stay with us. For our audience, the next session is on 19th August. We have Tim Leiberschett available. He's going to talk about pricing. I think it's a very interesting session again. 19th August, 6:30 p.m. Don't forget to be with us. In case you're not following us, follow us on LinkedIn and Facebook. We will ensure that you keep getting the notifications so you don't have to miss any session. Once again, thank you very much and stay safe, stay healthy. See you all next week.